Good morning, good morning, good morning, good morning. How you guys doing this morning? This is Keon Corniff, also known as Mr. Finance, your favorite financial educator and business coach. And today, guys, I just want to tell you about why life insurance could be a great money maker. Just a little bit about my story. I am the father of 5 beautiful kids, have 2 boys, 3 girls, and 1 more on the way, which will make that number 6. Before I got started in our campaign in the financial industry, I used to work 3 jobs. I used to work from 3:45 in the morning to 11:30 at night. I did that for about 5 years until I got introduced to this campaign. And when I got introduced to this campaign, I was very skeptical. But at the time, I just gained full custody of my oldest son, and I wanted to be in a position to learn. So because of this campaign, I started to learn. And ever since then, I've been educating people while still educating myself and getting better. So, some of the things that I've learned, I wish I learned it earlier. I wish my mother knew this earlier. I wish my family knew this earlier. And that's why I'm so passionate about what I do. And that's the reason why, I joined. The things that motivate me is my kids, my family. I'm definitely helping people. That's definitely one of the things that motivates me every day. So, why life insurance could be a great money maker, and why is it kept from you, right? You gotta think about that. Why nobody didn't tell you that life insurance could be a game changer like that? What is life insurance? Well, let's talk about what life insurance isn't. All right, life insurance is not for when you die, right? It is, but it's not. Because a lot of people think solely about life insurance and say, hey, if I die, then life insurance only benefit somebody else and not me while I'm living. But there's a lot of living benefits with life insurance, a lot. And they don't teach us about them. And that's the reason why many of us never got informed, never got educated, and we lack information. So life insurance, if you think about the word life, right? L-I-F-E. What does life means? It means that you're living. It means that I'm alive, right? So life insurance have a lot of living benefits, right? It's not solely about dying. But before you plan to own life insurance, right? Before you plan to own life insurance, you got to keep a few things in mind. All right? And here's the things that we got to talk about. Before you start to own any form of life insurance, guys, you got to make sure that you know your dying method. Okay? You need to know what is your dying method, especially if you're planning to save in life insurance. Right? If you're planning to use life insurance as a saving tool, a place to really generate some serious income in there, you got to make sure you know your dying method. All right, that is very important. It's called DIME method, DIME method. And your DIME method is pretty much used as a calculator to know how much insurance you need. So what I'm going to do is break that down for you. And then we're going to talk about some of the perks of owning the right life insurance and what are some of the things that they can do, okay? So, DIME, D-I-M-E. Now the D stands for debt, okay? That's what the D stands for, debt. How much debt do you currently have, right? You gotta know how much debt do you have. And you gotta calculate all your debts. So I'm talking about, when you think about debts, that's like your credit card, student loans, car, right? All these different debts, personal loans. You gotta think about all your debts. What kind of debt do you currently owe right now? All right, you got to think about all of that. You got to add all that up, put it next to the debt column. Then the I is your income column. Now, the way you calculate your income is that you got to calculate your net, all right? Your net annual income. You got to add that up, and then you got to times that by 10. All right, the reason why you want to times that by 10 is because if you have young children and they're dependents, they will need like 10 years of your income still coming in no matter what. Or if you have a surviving spouse, then you need 10 times your annual income, all right, to make sure that your spouse will be okay for the next 10 years to come. All right, so that's why you gotta have 10 times your annual net income and coverage. Now, another thing, the M stands for mortgage. All right, the M stands for mortgage. So you gotta know what is the balance on your mortgage, right? What is the balance on your mortgage? And you get that coverage as well, right? You get that, you add that in there, you calculate that. And then the E stands for education, which stands for educational planning for your children. All right. So if you have 2 kids and they want to go off to college one day, you got to calculate that and put all of that in factor. So if college tuition right now, let's say that's $100,000 for a child to go to a 4-year school on an average, right? Then you need to have that money put to the side if the worst case scenario happens. So the dime method just helps you to calculate how much how much life insurance that you need. All right, so that way you can know, okay, how much is this cost of insurance is going to cost me, and how much am I going to save based upon how much I want to save on a monthly basis if you're going to leverage life insurance. So that's the only thing about life insurance, is that's why they say it's good to lock it in very early, because the cost of insurance could be low. So I'll give you an example of the dime method. Is that, let's say that when you calculate all your debt, you have $50,000, right? You have $50,000 in debt. Let's say that your income is, I don't know, let's say $50,000 a year, times that by 10, $500,000, right? So right there, that's $550,000 in coverage that you need. And then when it comes to the mortgage, let's say that you have another $200,000 as a balance. So right now that's $750,000 of coverage that you need. Let's say that you have 2 kids. Let's say that you have 2 kids, right? So 2 kids going to school, college tuition is $100,000 each, right? For a 4-year college, you have 2 kids. Now that's another $200,000. So right there, you realize that, hey, I need $950,000 in life insurance coverage to be properly covered for me and my family. So if something was to happen to you, you'll be able to pay your family, your surviving spouse, or family members, or whoever, will be able to pay off that $50,000 in debt. They know the income wouldn't disappear for the next 10 years. You have 10 times that. And the mortgage will be paid off. And then, on top of that, college money will be put to the side for the children, right? For the 2 kids. They'll have $100,000 each put to the side, right? But now that's if you die, all right? That's what happened if you die. But what we gotta talk about is what happened, right? Let's talk about what happened if you live. What are the perks of life insurance if you live? Well, let's talk about the different kind of life insurance first. Well, they have something called term insurance, all right, which means that it gives you temporary coverage. It has no cash value, and all you're paying for is life insurance. Sometimes they give you coverage up to 30 years. And after 30 years, you no longer have coverage. You have to renew it. And sometimes the cost of insurance could go up because it's called annual renewable term. All right? So the cost will go up because, remember, your cost of insurance is determined based upon your age, your health, and so on. So now, let's look at another thing. You have something called whole life. Whole life. Now, whole life, you don't have to worry about renewing. Most whole life give you coverage up to like age 100 or even 120, even 121, right? So whole life will give you coverage. The problem, well, not a problem, but the issue with whole life is that it's really much fixed, all right? It's a fixed product. And what I mean by that is that the premium and the death benefit, don't have the flexibility to change. So if it's $100 a month, it's $100 a month. And they don't have a big, what's called grace period. It's normally a 30-day grace period. All right, so that's something that you keep in mind. If it's $100 a month, it's $100 a month for a whole life. It's a fixed premium and a fixed death benefit. All right, there's not much flexibility in them. Then you have universal life. All right, universal life insurance. Now, all right, I'm back. So universal life insurance pretty much is a life insurance that gives you a lot more flexibility compared to a whole life. And what I mean by this is that when you think about universal life, right? Universal life insurance is pretty much the life insurance that you could pay more or less 1 month, right? Like you could put more money inside of this, you could put less money inside of this, and you have a lot more flexibility. You could change the premium, you could increase, you could decrease, you can even skip a few months premium if you don't have enough, if you have enough money in the cash value. All right, so you have all these flexibility, guys, and the grace period is way longer, right? And some of them it's even like a 90-day grace period, right, where they allow you to miss 90 days. Well, you still got to make up for it and pay it, but at least you get that window to get your money right? So it's a lot more flexible with a universal life. Now, anything underneath the universal life side comes in different forms. So you may have what's called variable universal life, which pretty much means that variable, the V stands for your money being in the market. So your money will be reflected upon the market performance. So your money fluctuates. So if the market does well, your money does well. If the market does bad, your money does bad. That's in the VUL, also known as a variable universal life. But the good thing about it is that because it's a universal life, it still comes with a lot of flexibility, which still gives you a lot of the tax advantages that's tied to life insurance, which I'll cover shortly. But ultimately, you get a lot of flexibility still, even though your money is tied to the market. Then you have something called IUL, Index Universal Life Insurance. Now, Index Universal Life Insurance works a little bit different. It's different from the VUL because the VUL means that your money is in the market. The IUL says that your money is not in the market. It gets credited. It gets credited. Big difference. Your money gets credited by the market's performance, meaning that your money is never at risk. But most of the time, they normally have like a cap of how much interest you can make, which is anywhere from, let's say, 13 to 15% as a cap. And then they also have what's called a floor, which means that if the market was to go below zero, you could get either 0 to 0.75% positive. All right, here we go. So every time the market performs bad, they'll give you a positive return. It's called the floor. And that is most of the time the most guaranteed thing that they can guarantee you, because they can't guarantee, how the market will perform, but they can guarantee that every time the market does perform negatively, you'll get a positive return. And like I said, anywhere from 0 to 0.75% in some companies. Another good thing about IULs is that, like I said, there's no, with these products, there's no 59.5, there's no 70.5, all right? And a lot of it is really, really awesome because it gives you growth, it gives you safety, it gives you protection, it gives you a lot of tax advantages. And the tax advantages of life insurance, I want to cover that with you guys because a lot of people don't know that if you want a lot of tax advantages, you didn't know that life insurance gives that to you, right? Life insurance gives you a lot of tax advantages, guys, a lot. And because we don't know this, we miss out on the opportunity to really use life insurance for what it is, right? And we only think about life insurance for when we die. So a lot of the tax advantages that life insurance give you is the fact that you have like what's called tax-free death benefit, right? Tax-free death benefit. I like to call it tax-free inheritance, all right? Because when we hear about death benefit, that's the only part we learn about life insurance, and many of us never, ever, ever really look into it. And because we never look into it, we always become a victim of missing out on good things that life insurance gives. So the tax-free death benefit means that if something was to happen to you, remember we talked about your die method would help you to learn how much coverage you would need, right? So when you do that and you learn, hey, I need, say, $1 million in coverage. If something was to happen to you, your beneficiaries will receive this $1 million, right? And they'll receive this $1 million tax-free. They wouldn't have to worry about paying any estate tax. They wouldn't have to worry about paying any inheritance tax, none of that. Your family and loved ones will receive that money tax-free. They don't have to worry about paying no taxes. They don't have to worry about going through no probate, none of that. All right, they don't have to worry about none of that, guys. So they avoid all of that. So that's the good thing about, life insurance. And plus, whatever cash value that is also inside of these plans, they don't have to worry about paying any taxes on that too. So not only do they receive the death benefit, they also receive the cash value that you accumulate inside these plans tax-free as well. So that's what's really, really awesome about life insurance. Also, when it comes to tax deferred income, all right, tax deferred income, this is another tax advantage that you get. Tax deferred income means that any growth, right, whatever growth or increase in the money, right? So if you put in $100 and let's say the $100 grew to $1,000, you don't have to pay tax on the growth. So you don't have to pay taxes on the gains inside these policies either. You don't have to pay no taxes on the gains inside these policies because you already paid your taxes in the beginning. So there's no tax on the gains, right? Tax deferred income. And then when you need your money, you get tax-free withdrawals and you also get tax-free loans. All right, so you have two options. You can take out a tax-free withdrawal or you can get a tax-free loan. So those are some of the really cool things about life insurance that a lot of us didn't learn. And that's why we miss out on a whole lot of the perks that is come with it. So when you think about some of the perks of life insurance, is that life insurance gives you the ability to have a whole lot of protection. A whole lot of protection. I'm talking about protection against lawsuits. I'm talking about garnishments, even divorce and child support in some states. Your money is protected and nobody touching it. It's like MC Hammer, can't touch this. You know what I mean? Nobody can touch it. And then you also have what's called a great emergency source of income because, think about it. If an emergency happened right now, can you touch your 401k? Can you touch your pension? Can you touch your IRA? Because they have that rule 59 and a half. Right? There's none of that with life insurance. If you have surrender value there or cash value there, you could take out that money either through a tax-free loan or you can get access to it through a tax-free withdrawals. All right? There's no 59 and a half rule apply to your life insurance. And then when you think about also the fact that it's a great retirement supplement. And why do I say it's a great retirement supplement? It's because the fact that when you think about it, you could use this money for retirement. Think about it. Where else can you put your money and get tax-free withdrawals, tax-free loan, right? So it's a great retirement supplement because you don't have to pay no taxes on your distribution. The distribution is tax exempt. There's no taxes on distribution. And that's where you want to lower your tax bracket because when you get older, your tax bracket is not lowered based upon your age. Your tax bracket is lowered based upon the income. So if you could get tax-free withdrawals, tax-free loan, that means it will put you in a lower tax bracket as you get older. And that's what you want. You don't want to be in a higher tax bracket when you get older. Because if you use like the first two tax bracket where you get taxable money or tax deferred money, you could be in a higher tax bracket still even as you get older. That's why you can use life insurance to leverage that and get a nice retirement supplement to offset your taxable income. Then it's a great way to save for college, right? It's a great way to save for college because the fact that you could get coverage for your child or a grandchild, a niece or a nephew at the age of 14 days old, as soon as they got a social security, you can get them coverage. And that child could get coverage of half the amount of coverage that you have. So if you have $1 million policy, your child could have a $500,000 policy even at the age of 14 days old, right? But that's not what it's really about because if you start to put away an extra $100 a month inside of this thing, since they were young and they were just born, and start saving $100, by the time they're 65, you could have over $1 million for them, right? They could have $1 million set to the side. But more importantly, if you save for them, like if you was to save for their 529 and put away extra $200, $300 towards their college tuition, think about the amount of money you would have inside this plan for them, right? Think about that. You could save for their college here because, once again, here's some of the things. It doesn't affect FAFSA, right? They apply for FAFSA, it doesn't affect their FAFSA form, right? And if you have a lot of your money inside of these life insurance, then a lot of your income or savings or retirement supplement is not also going to affect their financial aid either. Because if you have 401ks, a house, and all these different assets, that can affect their eligibility for financial aid as well as FAFSA form. Life insurance is not one of the things that does that as well. So it's a great way to save for college and it doesn't affect a child's eligibility for FAFSA. All right. And then it's a great savings vehicle. It's a great savings vehicle because the fact that you have growth of up to 15% earning potential. So if the market does well, did you know in the past 30 years, the average return that the market have given is about 9%? Average return is about 9%. But you got to think about how much losses people have taken over those 30 years as well. But we all know that, past performance is not an indicator for future, future gains. But it's just a real something to look at. But just know that every time you have growth in this vehicle, you also have safety. So every time the market does bad, you also get a positive return of anywhere from 0 to 0.75%. And that's some of the things that we show people how to make sure that they have growth and safety. And that's why it's a great place to save as well. So those are some of the great things about life insurance that a lot of us didn't know and a lot of us didn't understand. And that's why you want to get a whole lot of it and start saving a whole lot of your money where you could not be taxed. And we can start learning how to avoid taxes. All right. And really start putting our money to work for us and leverage what life insurance really is. Life insurance is about the living. It's not about the dying. All right. That's why you got to really focus and start to learn how to create your stronger financial foundation. You got to learn about protection. You got to learn about debt management. You got to learn about emergency funds. And you got to learn how to understand investments. That's the reason why we want to teach you how to do all this in our free workshops, in our free coaching program. It's free. Just click the link above. Get in touch with me. Let's have a money talk. And let's show you how you can really put your money to work for you and really start winning the money game. All right. So my name is Keon Corniff again. Some of you call me Mr. Finance. Always remember that you're one decision away from changing the future for the better. So always remember that the choice is always yours. Remember to put God first in everything you do, and He will never steer you wrong. Have a blessed day, guys. I'll see you guys at the top. Bye-bye.